And it's a wonderful pleasure now to invite Elliot Harris, our second keynote speaker, to join the podium here. Elliot is from Trinidad and Tobago. He has over 25 years of international experience in international economics and development policy analysis. He knows the UN system like the back of his hand, and he also knows the multilateral and interagency coordination processes with a similar level of detail. Prior to his appointment, his current position as Assistant Secretary General for Economic Development and as the Chief Economist at the UN, he served as Assistant Secretary General and head of the New York office of the UN Environment Program. He began his career at the International Monetary Fund and was subsequently appointed Special Representative to the United Nations in 2008. Welcome, Elliot Harris.
Good evening, everybody, and first, thanks to Fletcher for that kind introduction and to the organizers for the invitation. I will probably survive this week. I'm really tired. It's been extremely frantic. We've had a lot going on. We've had 5 heads of state level summits going on in the UN, in addition to all the activities around Climate Week. And I want to concentrate my remarks here on something that may have escaped general attention. Now, everything that was said in the preceding panel and in the first keynote is entirely right. That's exactly true. We have to divest. We do have to put pressures on the government, so that's part of the message I'll give in a moment. But there is another approach that is taking root elsewhere, which is what Daniel was talking about, and that is the active ownership approach, where major shareholders are saying, look, we can also drive change from within. And the bigger we are, the bigger our influence is. And we have seen things happening, announcements made in this last week here at the UN that give us hope that we are actually starting to see a sea change in the way the private industry, private finance is thinking about not just climate change, but about sustainability overall. I'm going to speak about 3 initiatives that were announced for the first time last week, or this week. There are 87 companies, major companies active around the world that are members of the Global Compact, the UN Business Partnership, that announced that they are going to change all of their operations and the operations of their supply chains to make them consistent with a 1.5 degrees Celsius warming trajectory. Now, these 87 companies represent over $2 trillion in market capitalization. They are big, and they have made this commitment in a credible way, and it is the sort of thing that inspires emulation. The second announcement was by what is called the UN Net Zero Asset Owners Alliance, and this is an active shareholder type or active ownership type of initiative where we have 12 major institutional investors and pension funds, again with $4.2 trillion of assets under management, that have said that they are going to make their asset portfolios carbon neutral by 2030, zero carbon by 2050, by working with the companies that they own to make sure they change. And the last initiative is the announcement on Sunday of the Principles of Responsible Banking. That was 131 banks that came together, 45 of their CEOs were here, and they have committed themselves to following 6 principles for their business that are going to align their business with the principles of sustainability, with sustainable development more generally, and more specifically with climate action. And they represent $47 trillion of assets under management. Now, those are important changes, but there's one thing in particular that I want to single out. When the initiative of the business community, those corporates, was announced in July, there were roughly 30 companies involved. By the time they announced it here in September, there were 87 of them. When the Asset Owners Initiative was announced at the beginning of the year, there were 4 of them. Today, there are 12 of them. The assets under management have more than quadrupled. When we designed the Principles of Responsible Banking and released them for public consultation in November last year, there were 24 banks involved. By the time they show up here to launch them, there are 130, including all of the biggest banks in each of the regions of the world. Now, what that says to me is that this is becoming more than just a fringe phenomenon. This is mainstreaming. We have banks like Citibank that have signed on to these responsible principles. And what they've done as well is they've said that we will report on this every year. We set ourselves targets for the changes in the way we operate our business, and we will report on our progress every single year to the UN. Imagine that. We also had some commitments from the public sector. There were governments that came out and reaffirmed their commitments to the Paris Agreement and reaffirmed that they would realize the Sustainable Development Goals. But I am starting now to worry that we are not really seeing public policy commensurate with those commitments. How many governments, in making those announcements, also announced that they were going to eliminate fossil fuel subsidies? How many of them said, we will put a real and rational price on carbon? How many of them said, we will strengthen the building codes to make energy-efficient buildings the absolute reality of our lives? How many of them said, we will institute sustainable procurement practices so that we, as the largest consumer in every economy, will insist on having sustainably produced goods and services, or we're just not going to buy them? There were no such commitments this week. None. And so one has to wonder why that is. And I think part of the problem is that it's politically difficult, on the one hand. Many governments convince themselves that these are things that their electorates will not stand for. I don't believe that's true. I don't think anybody who was on this panel a moment ago thinks that's true, but they are able to use that as an excuse not to move ahead. I want to try and give you an example of what could be done to make government policy compliant with sustainability. So we know that part of the problem, a large part of the problem, is that it is still entirely possible to make a very healthy profit doing unsustainable things. And as long as that is possible, there are going to be people out there who will invest in it. You know? And so what governments need to do, if they want to be credible about the commitment to stopping the climate crisis and reversing that damage, commitments to sustainable development for their peoples, they have got to stop allowing it to be possible to make money doing the wrong things. What we're doing right now is we are investing green on top of the brown. There is no way that that makes any kind of sense anywhere. If we were to stop the flow of investment into brown, grey, sort of unsustainable activities and shift all of that into climate resilience, into building up the right kind of sustainable infrastructure, into sustainable development more generally, with its social dimension, with its environmental dimension, we could solve all of those problems without any difficulty whatsoever. The money is there. It is being invested as we speak, but it's being invested in the wrong things. And there's all sorts of ways that governments can change their policies to make that clear. As I mentioned a moment ago, there's government procurement. The government in every country is the largest consumer. If they say we are no longer going to consume things that are produced the wrong way, that sends such a massive signal to the markets that it'll make zero sense for any investor to put money into a firm that produces things that the government has essentially, I don't want to use this word, but blacklisted. There you have it. What the idea is, through government policy, to squeeze the profitability of unsustainable activities. And then it becomes a pure business decision to stop investing in those unsustainable activities. And then you can, of course, rely on your shareholders, the owners of these businesses, to demand that they no longer invest in these unsustainable activities. And that is, I think, part of the narrative that we have to move ahead on. We know that we cannot continue with the high carbon economy. We might not know the exact date and time at which the last coal-fired power plant will be shut down, but it will happen in our lifetimes. It will happen before I retire. And if I know that, then I know with absolute certainty that any money that is still invested in coal is going to be lost. Those assets are going to be utterly without value. You won't be able to palm them off onto somebody else. And the same thing will happen progressively in all of those other industries. And it's not just coal and gas and petroleum. It's some of the chemicals that we poison our planet with. There are lots of things that we know we cannot continue to produce that we will stop producing. And the narrative has to be, let's prepare for that now, and let's move out of these things before we get caught short. And that is the role of government policy. That is where we have to demand that the government policy become a clear and predictable signal of the way in which economies and societies will evolve or will be allowed to evolve going forward. I would like to make one last set of remarks around finance. As I said, this week we had some major commitments made, and I think a lot of that is happening under private initiative. The private sector leaders are recognizing, they're seeing that they can read the writing on the wall, and they're starting to prepare themselves for it, and they're moving way ahead of the government regulators, of the parts of government that are supposed to supervise and to regulate the activities of the financial sector. If you fix finance, you have put yourself very firmly on the path to fix everything else. And that is what I think needs to happen now. The government regulation and government policy has to really be directed towards making financial systems sustainable. Now, one way we can do that is to have government regulation correct all of the provisions that have an inadvertently negative effect. So after the financial crisis in 2008, there were changes made to the way banks are regulated with the view of enhancing the stability of the system, preventing these kinds of volatilities and shocks that led to some of the problems that we were trying to solve. All of that was fine, and all of that was necessary, and all of that actually worked, but it had the inadvertent consequence of making it very expensive for banks to lend long term. Because if you are exposed long term, the degree of provisioning, the money you have to put aside to cushion any potential loss on that exposure, that is much more expensive. And capital markets are already biased towards the short term. This regulation had the impact of just reinforcing that, and it's very difficult now for the average commercial bank to get involved in financing something over 30 years. And yet what we're talking about in the transition to the low-carbon economy, to the green economy, to the sustainable society, requires investments in sustainability. These are not things that you get done in half of a year. You need 10 years, 15 years, 30 years, and the finance for that is very difficult to mobilize because of the way the system is put together. There's a lot of disclosure going on. There was a task force on climate-related financial disclosure. The financial sector has accepted that climate risk is also a financial risk, and they're learning now how they go about disclosing that risk so they can manage it. And there are many other kinds of risks that have to be disclosed. But one option that governments can take under advisement would be to say, well, let's make that kind of disclosure or other kinds of disclosure mandatory. There are some stock markets in the world. If you want to list your company on that stock market, you have to disclose your financial footprint. And strangely enough, many of those companies, most of them actually, have a share price performance that is as good as, sometimes even better than, the performance of companies that don't disclose. Why? Because investors value that information. It helps them make the right kinds of choices. Governments, by requiring that kind of disclosure, can accelerate this. Fiduciary duty it was raised a couple of times in the panel. If you do not take into account the things that might affect the value of your asset, then you are not doing due diligence. It's as simple as that. And we know that if you look over the longer term, things change. People change, societies change, new laws are passed, the environment, the physical world around us changes. If we are not aware of how an investment impacts upon the people, upon the world around them, then we're not aware of all of the changes that might affect the value of that asset going forward. And yet, in this country, more so than any other OECD country, the definition of that fiscal, fiduciary duty is very narrow. You're looking only at the financial return. It's a short-term type of orientation. And yet, if we want to be truly sort of living up to our responsibilities as fiduciaries, we have to know, well, how is that asset going to be valued in the future? And there, I think, if there is a change in the way in which you define fiduciary duty, you can enable a lot more of investment, because many pension funds and institutional investors would, in fact, look more favorably at different types of investments that are more sustainable if they could take into account the positive impact that these investments will have on human outcomes and on environmental outcomes. That's taking into account the longer-term drivers of value. And that brings me now to something that was said a little earlier. We are on the brink of a revolution in investment, and it's the millennials. These are people who have an entirely different set of values than what their parents, the baby boomers, had. And just last week I was talking to a wealth manager, and he said that is the biggest change that the financial industry is grappling with. We talk about impact investing, and that has moved out of being a fringe phenomenon. It's being mainstreamed throughout the entire financial industry. But we have only just scratched the surface. That millennial generation in the next few years is going to inherit the single largest intergenerational transfer of wealth in the history of our species. It'll never be repeated again. And they are not prepared to invest that money the same way their parents did. They won't. The issue we're going to face with that, though, is we have to be able to measure the impact of whatever investment they do so that they can be sure that they're investing in the right things and having the right kind of impact. And we have to make sure that there is a suitable pipeline of sustainable projects into which that money can flow. If we can work on those two tracks, we will find that the practice of investment and the principles and the ultimate objectives of investment are going to change whether governments like it or not. And so that then leads me to ask, and I'll close with this, well, so if it's all changing in the right direction anyway, why do we need the governments? Well, that is a good question. And I think part of the issue is that, well, on the one hand, we want to make sure that the governments aren't in the way. If they do the right things, they can accelerate the change. And we live now under the gun. We have to make the changes as quickly as we can, but we have to make the right changes. And so the sort of inadvertent consequences that I was talking about a little bit earlier in the financial regulation space, we have to make sure we avoid them. Secondly, there will always have to be regulation, because we won't, none of us here in this room or anywhere would just agree that we leave it all up to the markets. That's not how you get good outcomes. But we would not get good outcomes if we're regulating yesterday. We have to be regulating today, and we have to be preparing to regulate tomorrow, and we have to do it in the right way so that we're not discouraging the right kinds of developments, and we're not encouraging the wrong kinds of them. And so I also think that one of the targets of the campaigns, and Sapora mentioned it just at the end there, we need to target not just the ones who produce the pollution, who generate the greenhouse gas emissions. We need to target our governments. And whereas the active owners in a company can influence the boards and make changes in corporate policy, well, we can influence our politicians as well. And in this country, at least, you have that opportunity every 2 years at the national level. And one has to make it clear that these are the things that are important. We know that they're important, and we're not going to let you forget it. Government policy has to be directed at the sorts of outcomes that we want. It has to be directed at stopping the climate crisis. It has to be directed at sustainable development. And if it's not directed there, then we will change the government. Thank you.